So the month is officially over.
Yes, and the quarter too, right? So we had the quarter end, month end wrap up this week, and the RQF, our Radar Quant Fund, posted a 6.31% return in March, netting about 3.1% in alpha. So total so far year to date, the RQF is up almost 19% with a little bit over 8% of alpha against the S&P 500.
So we're
And
almost
this,
we're almost doubling the performance of the S&P in just the first 3 months, which
yeah,
it's not too bad, but it's also uh, not abnormal for RQF. I'm
right. And interestingly enough, this is also a very low touch approach. RQF is not something where, it doesn't day trade. It's 100% systematic, so there's literally no emotion involved. It trades into the close. So, and all these signals that encompass the RQF program are put into the daily quant deck, which you can find on our website in the members area. And we wrap all this into a nice daily report, this and some other market metrics. But again, it's very low touch. I think outside of rebalancing, which happens once a quarter, we've had like four position updates so far year to date. So if you think about it like that, it's four changes in the account. We're running 8% alpha right now. Not bad, not bad. And I think it's something that this is our first started a public track record here with RQF, so it's going to take some time for it to really cement itself. But so far, we're off to a good start. And I think for the available models out there and the grade at which this is low touch, this is unparalleled to what you can find. Now I know there's going to be some junkie out there who's like, oh my God, I'm up, 60% year to date or 30% year to date. RQF is up 18%. It's trash. And yeah, you guys might be trading options. You guys might be doing things that are a bit more aggressive. Remember, this is 100% systematic. This is not a high frequency trading model. This is very low touch. So for what it's doing its job and it's doing it quite well. And I'm happy and we're both happy to share this progress live along the way here. And you can find the most up-to-date version of the monthly report for the RQF pinned to our X page. If you go to our X page, it's going to be pinned right there. That's where you can see it every month. We update it in real time, so everyone is always in the know.
Yeah, I also want to reiterate just how good it is to just have a nice buy and hold strategy and actually get meaningful returns, not just the boring, 10% annual growth rate, actually getting a 48% annual growth rate, which is what the RQF averages. Both of us, we have day trading backgrounds. We've definitely been around the block and day traded full time for many years. And it really is nice to not have to sit in front of a computer stressing constantly. It's nice to have a
Yeah,
buy and
it's
hold
true.
strategy
It's that's so true.
and actually
Yeah.
like pull its weight and give you the returns that match what what I was getting with day trading. So it is pretty
Right.
nice.
Right. And obviously these returns, nothing's linear, right? So it's going to be cyclical. And then the key here is not obviously focusing on the bigger picture, right? Bear markets will happen. Right now we're in a bull market, and that's undeniable. If you want to argue that, we can have a whole different podcast about that. But we're in a bull market, and bull market returns are pretty easy, right? When everything is going up, it's not very challenging. But when things start changing, catching those pivotal moments in the market's time series is where we believe RQF is going to make its most impactful stance, or provide its most impact in terms of uh, alpha and overall performance, right? Because again, when the market's going up, not so hard, but when the market starts turning and we start pivoting across all these all these different allocations dynamically, right? Then that's where the true alpha comes. That's where you're not only are you beating the market in an up market, but you're actually generating positive returns in a down market. So I think that as we go along here, we're going to start seeing those things happen in real time. And that's the whole beauty of what we're doing here with RQF. It's going to be live, tracked monthly, posted on X. And obviously for the members and anyone in the Discord, they get live updates on a daily basis through our quant deck report. But let's dive into the market this week. The Nasdaq didn't really do too much this week. It kind of went sideways to down, right? We did not hit a new all-time high this week on the Nasdaq,
Very
and
unfortunate.
very unfortunate. I think it's so over, right? Like this is the end. But no, this is normal, like normal behavior, bull market behavior. It's like a relay race, right? So this is the beauty of indexes, or indices, right? Unlike one specific stock, right now, Nvidia and Meta are the two Mag 7 leaders in the market, right? And then Apple and Tesla are the two worst performers. If the bull market holds, the regime stays locked in, there's going to be some sort of rotation, right? What's going to happen is money will flow throughout the Mag 7 names. It's not going to just be the same pinning position where Tesla's down 30% for the year and Nvidia is just going to endlessly go up. And, that's not usually how this works. So when you own an index, what happens is it's kind of like a relay race. When one of the leaders starts to tire out, money flows into the other one, and you kind of have that in the index. You kind of are invested in all of them, so you kind of have exposure to all the movers, right? Now, they're not foolproof, obviously, right? Bear markets happen. That means when pretty much all the stocks go down, but you get my point. And something very interesting is happening, though, in the NASDAQ as of late. Now, I know we just said it did make a new all-time high, and that is not what I'm talking about. What I'm actually talking about is its comparison to the S&P 500. So this right here is a graph below the NASDAQ. For those that are just listening, what I've done is I've displayed the relative performance between the NASDAQ and the S&P 500. So if you were to hypothetically long NASDAQ and short the SPY. Now, typically, and this doesn't always happen, but typically in a bull market, what's going to happen is tech is going to be an outperformer. So inherently, the NASDAQ is going to outperform the S&P 500. That's just how it has been for a very long time. Now, what you're noticing happen here, quite interestingly, is ever since the end of January, this ratio has been breaking down. The Nasdaq's still been going up, though, so it's not like the Nasdaq's rolling over. It's just the S&P 500 we've seen even just on the last day of the first quarter, which is today when we're recording this, the S&P 500 hit a new all-time high. So the Nasdaq did not, right? So we're starting to see this divergence here in the S&P 500 where it's going up and the Nasdaq isn't really catching up. And if, again, bullish trend holds, regime stays locked in, I do expect some reversal here to happen. And typically essentially what that means is breadth is going to widen across the Nasdaq, help lift the Nasdaq up, or the S&P 500 is going to come down a bit with the Nasdaq holding some sort of resilient bid. But we'll have to see how that plays out. But I do think...
Couldn't this be possibly an early sign of growth slowing down?
Yeah, I don't... again, we can't really measure growth like this, right? Like, this doesn't really define growth. It just defines expectations, right? It doesn't, like, in terms of... It defines demand for tech. Now, could that be somewhat of a growth pointer? Maybe, but I think we've seen we have a live growth index in our daily quant deck, and throughout this whole period, where the Nasdaq and this ratio between Nasdaq and S&P fell, our growth index actually picked up quite aggressively. So it's kind of giving a contrary signal, right, to what this specific ratio is telling us, but. Nonetheless, could it be a sign that if we go back in time, this does peak and roll over at times where markets go down. So this could be some sort of early indicator, possibly. But the contrary is, again, if regime is locked, trend is locked, right? NASDAQ trend is locked and regime is locked, where it is right now, the odds of this reversing higher are quite high. So I wouldn't use this really as I wouldn't isolate a single data point in a larger series of things and pivot yourself or put yourself in a position to be bearish, right? Remember, let all the data guide you, not just one, not just your favorite data point. So I think that's what we have to do in total here and look at it from the big picture, that there's the Nasdaq has been underperforming the SPY for some time now, for a couple months. Maybe that changes in Q2. I think it should again, regime and trend stay locked. It should. This should revert. Nasdaq should start accelerating, but we'll have to see. But I think with that, we can go right into Bitcoin, right? Because that's obviously a big topic lately. And Bitcoin's holding up quite well. It's not at new all-time highs yet, but it's also really not selling off hard. It's pretty much consolidating within the um, first quarter range. After the March range, I shouldn't even say first quarter. It's within the March range, and we're up near the upper end of the March range. So maybe this starts breaking up and breaking out. We'll have to see. I think the halving is in about 20 or so days, something like that, 20, 25 days from now. So we'll see how price reacts into that. But obviously, another indicator of risk here, right? Like if you just look at overall risk sentiment, Bitcoin up near 70K and near all-time highs. It's not the most bearish thing, right? So
Yeah. Is the halving happening during a weekday or a weekend?
I don't know. I believe it's supposed to happen on 420. Is 420 a weekday?
Let me see.
Surprisingly, 420. I know it's a joke, but
Yeah, it's a
that's when
Saturday.
it's a Saturday. So we'll see. I mean,
I'm curious if that makes a difference, like with the ETFs not trading. I wonder
I don't
if.
know because I think the biggest thing about the halving is just going to be really the oncoming supply that's available from the miners. I don't know if it's going to make so much of it. Like, I don't think that halving itself is the driver. I think it's what the halving does to the chain moving forward that is the driver. It's not so much that second in time. It's more of how we progress forward from that juncture that's going to matter. But we'll have to see. I mean, um, overall, Bitcoin is up and it's holding its trend. It's above mid vamp, right? So we're above mid vamp on Bitcoin. We're currently under the prior all time highs. As long as we're above mid vamp, I mean, all new all time highs should be expected. The base case for Bitcoin right now, ever since it reclaimed its mid vamp at the end of March, has been base case new all time highs. And quite frankly, the same thing is with the Nasdaq too. I mean, we're still holding mid-vamp, believe it or not. Like despite me elaborating on its weaknesses against S&P earlier, like we are holding mid-vamp quite well. So again, we should see new all-time highs here rather swiftly if we can hold this mid-vamp level, which we seem to be doing right now. So
Yeah, we
that's really like
still we still haven't had a significant dip to lower vamp. Pretty much every time the Nasdaq broke through mid vamp, it bounced right back up. Yeah, I
yeah, I
think it's
know it.
been how long has it really been? I
Oh,
would
I think
say
it's
that
been
like
since
start of the year.
Feb.
I would say the start of the year is a real dip. I don't. I wouldn't even consider anything else a real dip. Like even that day. Um,
I guess we didn't close low, and I see what you're saying. Like, yeah, we recovered too quickly. Yeah, I see what you mean. And another thing that's going on here with the market that's interesting is VIX, right? So like, we got S&P at new all time highs, right? New 52-week highs. Let's see if we closed it. Did we close there? No, we closed it. We hit it. We didn't close there, but we got VIX still at 13 going into the extended weekend, right? So VIX is at 13. Now, what is going on here? Why is this not breaking down? Right? So like, why is VIX not lower? And this goes back to our prior conversation. Was it 1 or 2 weeks ago that we're actually seeing the volatility space hold up with realized vol? If we take a look at our vol, right? Our vol is still up here it's up in the nines. It was in the 11s. It's now in the nines. I do think that we could see this come lower. Now I don't know how much lower, but I do think that it's hard for anyone looking at this to see, right? So Arvol's up here, right? So Arvol's still a little up there compared to what we've seen. Do we see a breakdown here? That's to be seen. But I think that where VIX is right now, it's we could see lower VIX, and I think that's what we might need for more of a solid flush out. I still think VIX is a little too high given where we are for the market to really put in a significant pullback. You're going to want a lot of hedges to be washed off the table, right? So I think VIX is up a little too much right now. I think we need to see a VIX washout. Depending on how that happens, that would mean like more of a relief rally up. Right now you might say, oh, this is up. No, I'm talking like like this type of move, right, where you just an aggressive flush. I don't know if we see that.
Yeah, it seems very calm still.
Yeah, it seems very calm. So I'll have to see. We'll have to see how this progresses, but I think we're going to need that kind of flush out. But that's more of a just an observation, and we can bring it back to just the charts and keeping it real simple, right? ES above mid vamp, right? And NQ above mid vamp, ES above mid vamp. Keep it simple. Above mid vamp, base case, just new all time highs. It's worked all this year, and it's worked in the past. Above mid vamp, expect new highs. Like it's just how it works.
Yeah,
The
you
only
really
time
got to
it
just
doesn't,
keep it simple.
yeah, it doesn't work occasionally. Now, nothing's foolproof, right? You have to look at the bigger picture. It's not like, for example, here in August, we got back above mid vamp. We didn't take out the July highs and we actually rolled over. But you can't isolate single scenarios and on a broader term spectrum of where things actually work. For example, we could just go any point in time, right? Above mid vamp, you grind up new all time highs. It's how this works over the long run. Your odds of success are that your odds of your hit rates very positive if you bet that new all time highs are coming if we're above mid vamp. It's just how it works. So I think that that's the base case, like you just said, keeping it simple. There's no harm in doing that. Um, but I think given that with ES, NQ, and Bitcoin, we can actually move to commodities, and I think this is where we can have a good discussion because there are a lot of people that are very bulled up on the inflation scape, and I want to give my thoughts on that. Now, I think I've been very clear throughout the past couple of podcasts, or even the past 6 months to a year, right? That it's very hard for inflation to get down from 9 to 2%. Very easy to get it from 9 to 5. That range in between, it's the struggle. It's a battle, right? And we've reiterated this multiple times. So now people are saying, okay, it looks like inflation's bottomed. They're looking at Supercore. We know we've discussed all that being nonsense, right? It's all garbage. Just focus on headline. You'll do way better. You'll be more focused. You'll have less noise, right? But even headline, people are claiming, look, it could turn around. There could be a bounce. And quite frankly, yeah, there will be a bounce, some sort of bounce in headline. That's to be expected. The market's even expecting it. Like we have been saying this for a while. Headline is probably going to bounce around and it's not going to go straight down to 2, right? The problem is how long it bounces around. No one really knows yet.
Well,
People are looking at
what do you
inflation.
mean by the market's already expecting that? Where do you see that?
So if we go to, let's see, inflation now. If we go to the Cleveland Fed's inflation nowcast, right? CPI for March is expected to be 3.41, right? So we're at 3.2. So it's expected to come in higher, right?
Okay.
Now people are like, oh, okay, but it's accelerating. Okay, so inflation's actually accelerating up. Well, it doesn't work like that so simply because unfortunately with inflation being a year-over-year measurement, there are things called base effects. And I wrote a whole little post on this on X about how these base effects work in commodities, but I want to go over it now. So if we take a look here, I know this chart's might be hard to see, but let's take a look here on these black lines. For those listening, I drew horizontal black lines indicating the monthly closes going back to March of 2023 all the way up to July of 2023. And what I've done is I've taken the lowest possible monthly close, which is May 2023, and I drew a measuring tool from where we were at the May close to where we are right now. So what this is doing is assuming commodities don't change from the current price they are now until the end of May, because remember, commodities are a big basket in the are a big component in the CPI basket, and they are measured on a year-over-year basis, on a monthly basis, right? So this is just a quick a quick handed way of measuring it, right? But this is going to explain what I'm talking about with base effects. So if you were to look where we are right now, commodities have changed from March to March. If we go from the March close to the March close, 9.63%. I mean, commodities year over year are up 9.63%. So if commodities don't change from where they are today and we go down to May, commodities will be up in the inflation basket 18.16% year over year. That's doubling what they are up right now, even if commodities don't move today, because remember, we're measuring year on year change. So what's going to happen here is we're going to run into a period of base effects where commodities, we saw this drop in mid 2023, where in April, commodities peaked around, or the GSG basket peaked around 21 and fell all the way down to about 18, which is an 11% drop. And then it rebounded rather quickly. So what's going to happen is you're going to have this kind of tailwind pushing up inflation for the next 2 or 3 months. And then what's going to happen is you're going to get a reversion. What's going to happen here is you're going to see these monthly closes start climbing, meaning commodities bounced from May all the way through September of last year. So in that process, what's going to happen is the gap, the percent change, if commodities don't move too much from where they are right now, is basically going to close just as it's going to widen over the next 3 months, even though commodities, let's just say, don't move, right? They're pinned where they are right now. The historical reference points will first drop and then climb again. If commodities stay where they are or in this, give it $1 around this price range from now until November, I'm not saying they will, commodities will be flat on a year-over-year basis, right? So they're plus 9% right now. And if they don't move anywhere, they'll be plus 0. Now, the problem with this is, the problem that everyone's, focused on is inflation slowly ticking up. But what you have to look at is the bigger picture. So if we take a look at commodities, we scroll out and we just remove all this noise here.
Well, I mean, the market knows about base effects. It knows how CPI is calculated.
Correct.
Does this really affect the market performance?
No. That's what I'm trying to get at, right? Because people are going to see this uptick in inflation and they're going to claim, oh, inflation's rising, but the market's already, like I just said, we have Cleveland Fed looking at this already. It's priced into the CPI swaps. The market's not stupid. This is something very simple and visual the market can kind of see based on where commodities are trading today. This is not very complicated. But the reasons I bring this up is if we look at commodities as a whole, right now, we're about almost 4% under the September 2023 highs. So commodities as a whole are actually lower than where they were in September. But because of base effects, there's going to be an incremental rise in commodity pressure in the inflation basket over the next 2 to 3 months. Now, this goes back to us saying that it's very hard to get inflation from 5 to 2 because in rapid rises and rapid drops like this, there's a lot of lag that is left on the table for base effects to run their course. The market sees this. So you got to look at inflation over the broader term. We can observe headline CPI, it's at 3.2%, right? But if we take a look at the bigger picture, commodities are up and we are in a regime where inflation has strength. Commodities can continue to rise. But before we start really thinking, or even the market starts thinking inflation is going to be a problem, commodities have to be a lot higher than here.
Yeah,
right?
I mean,
Because
inflation is good for bull markets. It's just
to a degree.
Yeah, it's
right?
uncontrolled and unpredictable inflation that becomes a problem.
Correct. So the situation here right now is, well, based on what we've been speaking about is, look, commodities are bullish trend. Regime supports higher or a firm bid in commodities, right? In terms of strength, commodities have the trend and the regime behind their back to go up. The problem is you have the Fed on the other side of the table. You can argue the Fed's restrictive or the Fed's not restrictive. That's what makes this a very hard trade to long. Now, I think commodities this is what makes commodities a very hard thing to be long, specifically or concentrated, right? Just commodities, not the market, because you got the Fed on the other side of the table that directly are going to or be fighting against inflation, and the main driver in commodities is going to be supply demand, but inflation is usually the big driver in the commodity space, right? Because again, they're price based. There's no growth, right? Unless you cut demand, right, or there's a demand driver, commodities themselves don't grow, right? They're not companies. There's no earnings. There's no market capitalization, right? So inflation is a very big driver in commodities. Now, the nearest thing I can kind of put this towards or assimilate this to is going to be gold. Now, if we take a look at gold and we go back, gold's breaking out now. It looks good, right? But if we take a look if we go back in time in 2022, you see how gold had this bullish trend flip and went up.
Yeah.
And we actually were up here around the 180 mark, 185 mark, real time calling this a fake bull run. And the reason we were calling this a fake bull run then is the Fed was on the other side of the gold trade. They were hiking interest rates, right? Gold does not like higher interest rates. Gold is a deflationary asset. Gold loves rate cuts. So even though we had bullish trend, inflation, we were in a stagflationary regime at the time. This was not the play because you were on the other side of the Fed's hand, right? And now we're seeing this gold actually hold a bullish trend flip from October and break higher. And this is in conjunction with bonds moving up slowly. So this has some support, but we'd like to see bonds actually push up higher. But long story short, gold is being supported by the idea of rate cuts, right? Rate cuts are coming. Gold likes rate cuts. Gold goes up. It's on the same side of the Fed now. Commodities, again, on the other side of the Fed's hand. Now, when commodities were going up while the Fed was hiking interest rates in 2022, what ended up happening was the Fed was well behind inflation. Even though the Fed was hiking, commodities had the stronger hand against the Fed, right? We could simplify that. Now, I don't know if we're going to get that same follow through. It would be nice to see for those that are long commodities. I want to see those guys that have high conviction bets on commodities make money. It's hard when you're fighting the Fed in this scenario. Now, a lot of people will say, "Oh, the Fed lost control," and I beg to differ. And that's where we're going to bring it into the final chart today. We're going to talk about long bonds, right? So if we look at long bonds, if this can still change on us, I mean, we're not in a bullish trend yet, but for a market that thought the Fed had just lost control on the whole inflation fight, bonds have gone the complete opposite direction, right? For a market that is betting the Fed is no longer in control of inflation, just going to basically throw the inflation target out the window, let inflation rip. Bonds have literally done nothing but go up maybe outside of one day since the last FOMC meeting, where everyone deemed the Fed losing control. So if you believe that the Fed has lost control and the market believe the Fed has lost control, we would see bonds a lot lower, rates a lot higher as people try and reprice a new environment where the 2% is no longer the 2% target, or 3% is the new 2%, or whatever they want to call it. Now, similarly, right, we saw some duration issuances this week in the FOMC with the Treasury auctions, and people were actually picking up duration. They were coming in and bidding duration. These weren't weak auctions. So it's not like people didn't show up to the auctions this week for duration either. We'll have to see how this progresses. Could we bounce off Momo here and go lower? Sure. But again, for someone claiming that commodities are rip-roaring because the Fed has lost control, I don't think that's the right angle to take. I think commodities are in fact up. Look, we're in a positive inflation environment. Inflation has strength. It doesn't have the same runaway effects, though. It has these resiliency effects. So I think you have to weigh them out on each side. And like we always say, in this space, we're always going to be the voice of reason. We're never going to be too far one way or too far the other way. You might look at us now and say, man, these guys are uber bullish. They are never bearish. You just weren't around for 2022. Okay, we were bearish all through 2022. So it's not like we're very one-sided here. I do want to make it clear, we go where the data tells us to. Like I said earlier, 100% systematic. RQF. There is no, I'm feeling bullish today, but the market's going down, and all the bear signals are there, but it's all fake. There's none of that shit. It's down to the point. If the data says this, we do it. It doesn't matter what our opinions are. If the data goes bearish on Monday, we're going bearish on Monday. It's not very hard, and people get lost in the whole mental situation behind it, but I want to keep it very simple. Ride the wave for as long as possible and compound as much as you can, and then we get off the grid. That is the game plan. And I thank you guys so much for listening. If you have any questions, feel free to reach out to us on X at The Market Radar, or go to our website at market-radar.com.